What's the best way to make serious money online? Forex, crypto, or the stock market? If you've ever wondered which one is right for you, you're in the right place. So many people ask me, where should I put my money? What's the quickest way? What's the safest way? What's the best way? And honestly, the answer isn't always straightforward because it really depends on you, your goals, your risk tolerance, and how much time you're willing to put in. Today, we're breaking down the pros, cons, and profit potential of each of these massive markets so you can decide where to invest your time and hard-earned money. We're going to look at what Forex trading really involves, beyond the flashy ads you might see. We'll dive deep into the world of cryptocurrency, the digital frontier that promises fortunes but also carries significant risks. And of course, we'll cover the good old stock market, the traditional powerhouse for wealth building. So grab a coffee, maybe a notepad, because class is in session. Don't forget to like, subscribe, and hit the bell icon so you don't miss our next money-making breakdown. First up, Forex or foreign exchange trading. This is where you trade currency pairs like EUR USD or GBP JPY. Here's what you need to know. Forex is by far the largest financial market in the world, with trillions of dollars traded every single day. Think about that volume. It dwarfs stock markets, it dwarfs everything. It's the backbone of international trade and global economics. And for individual traders, it presents an opportunity to profit from the fluctuations in currency values. It's not about buying foreign cash for your vacation, it's about speculating on the direction one currency will move against another. So, how does it actually work? When you trade Forex, you're always trading a currency pair. For example, if you trade EUR USD, you're speculating on whether the euro will rise or fall in value compared to the US dollar. If you think the euro will strengthen, you buy the pair. If you think it will weaken, you sell. These movements are measured in pips, which are tiny fractions of a cent. It sounds small, but when you're trading larger amounts, or using leverage, those tiny pips can add up to significant profits or losses very quickly. One of the biggest draws of the Forex market is its incredible liquidity. What this means is that there are always buyers and sellers available, so you can generally enter or exit a trade at or very near the current market price, especially for major currency pairs. This high volume ensures price stability in the sense that one single entity can't easily manipulate major currency prices, though, of course, big players like central banks can have a huge impact. Another major advantage, and one that attracts a lot of people, is that the Forex market operates 24 hours a day, 5 days a week. It starts with the Sydney session, then Tokyo, then London, and finally New York, rolling across the globe. This means you can trade whenever it suits your schedule, whether you're an early bird, a night owl, or have a regular 9-to-5 job. Now let's talk about leverage, because this is a big one in Forex. Brokers offer leverage, which means you can control a large position with a relatively small amount of capital in your account. For example, with 50-to-1 leverage, you could control a $50,000 currency position with just $1,000 of your own money. This can massively amplify your potential profits from those small pip movements we talked about. However, and this is a huge however, leverage is a double-edged sword. Just as it can magnify your profits, it can magnify your losses just as quickly, if not more so, because of how fast things can move. Next, crypto, the wild west of trading where you can 10 times your money or lose it all in minutes. Here's the deal. Cryptocurrencies are digital or virtual tokens that use cryptography for security. They operate on decentralized systems, meaning they aren't typically controlled by a single entity like a central bank. Bitcoin was the first, and it's still the king, but now there are thousands of different cryptocurrencies often called altcoins, each with its own supposed purpose, technology, and community. So, how does crypto trading work? You typically buy and sell cryptocurrencies on specialized exchanges, similar to stock exchanges but for digital assets. Think Binance, Coinbase, Kraken, there are many. You'll need to create an account, verify your identity, and then you can deposit fiat currency, like US dollars, to buy Bitcoin, Ethereum, or other coins. You'll also need to understand crypto wallets, which are digital addresses where you store your coins. There are hot wallets, online, convenient but less secure, and cold wallets, offline, more secure but less convenient. Managing your private keys, which are like the password to your crypto, is absolutely critical. One of the biggest attractions of crypto is, without a doubt, the potential for incredibly high returns. We've all heard stories of people who bought Bitcoin for pennies and are now millionaires, or those who got into a new altcoin early and saw its value skyrocket 100 times or even 1,000 times. This moonshot potential is what draws so many people in, hoping to catch the next big thing. And it's true, such gains have happened and can happen, but they are often accompanied by enormous risk and speculation. Another aspect that appeals to many is the decentralized nature of most cryptocurrencies. The idea is that they are free from government control or interference from traditional financial institutions. The innovation and technology behind crypto are also fascinating. Blockchain, the underlying technology for most cryptocurrencies, has potential applications far beyond just digital money, in supply chain management, voting systems, digital identity, and more. However, let's get real about the downsides, and the biggest one is extreme volatility. Crypto prices can swing dramatically in very short periods, often with no apparent reason. A tweet from an influential figure, a rumor, or a change in market sentiment can send prices soaring or crashing by 20%, 50%, or even more in a single day. Then there's the lack of regulation, or inconsistent regulation depending on the country. While some see this as a plus, it also means there's a higher risk of scams, fraud, and market manipulation. Security risks are another major concern. Chapter 3. The stock market. Old school, but still a goldmine. Finally, the stock market. The slow and steady path to wealth, but is it really better? Let's break it down. The stock market is where investors buy and sell shares of ownership in publicly traded companies. When you buy a stock, like Apple or Tesla or a smaller company, you're buying a tiny piece of that company. If the company does well and its profits grow, or if investors believe it will do well in the future, the value of its stock will likely go up, and so will the value of your investment. How does it work? Companies issue stock to raise capital for expansion, research, or other business activities. These shares are then traded on stock exchanges like the New York Stock Exchange or the NASDAQ. Prices are determined by supply and demand. If more people want to buy a stock than sell it, the price goes up. If more want to sell than buy, it goes down. One of the biggest pros of the stock market is its proven track record for long-term growth. Over decades, despite crashes and recessions, the stock market as a whole has historically provided solid returns, often outpacing inflation and other types of investments. Compared to something like crypto, the stock market is generally much more regulated and transparent. Publicly traded companies are required to disclose a lot of financial information regularly, like quarterly earnings reports. There are regulatory bodies like the Securities and Exchange Commission in the US that oversee the market to protect investors from fraud and manipulation. Another attractive feature for many investors is the potential for dividends. Many established companies, especially larger, more mature ones, distribute a portion of their profits back to shareholders in the form of dividends. This can provide a regular stream of passive income, which you can either take as cash or reinvest to buy more shares, further compounding your returns over time. While the long-term picture is generally positive, the stock market usually offers lower short-term returns compared to the potential explosive gains you might see in crypto or highly leveraged Forex trades. The stock market is also susceptible to market crashes and corrections. Economic recessions, geopolitical crises, pandemics, or even just changes in investor sentiment can cause sharp and sometimes prolonged downturns in stock prices. This brings us to another con for some: the stock market generally requires patience. True wealth building in stocks often takes years, even decades, thanks to the power of compounding. Alright, so we've dived deep into Forex, crypto, and the stock market. As you can see, there's no single best market for everyone. Forex offers high liquidity and 24/7 trading with the potential for big wins and losses through leverage, but it's complex and risky. Crypto is the high-octane, volatile world of digital assets, massive potential rewards, but equally massive risks and a steep learning curve. And the stock market? It's the more traditional regulated path, great for long-term wealth building, but generally slower and requiring patience. The right choice for you really boils down to your personal financial goals, how much risk you're comfortable taking, how much time you can dedicate to learning and managing your investments, and frankly, your personality. So, which market are you leaning toward? Drop a comment below: Forex, crypto, or stocks. I'm genuinely curious to hear your thoughts and which one resonates most with you after this breakdown.